In this week's update, where your current focus should be, how to de-risk the world's best long-term wealth compounders, investing rules are changing permanently and significantly, and the risk and reward around lithium. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. All right, got a lot to get through today. I guess now May is concluded. We can look back and the results are pretty impressive. So much for the sell in May stupidity. You just want to ignore that in the future. The S&P added 4.8% for the month. The Nasdaq added 6.9%. So May was once again pretty good, as it has been over most of the last decade. Now, admittedly, NVIDIA is certainly helping that in America, and because it's increased in value very, very significantly. And it's definitely setting the pace. And there's a virtuous circle here where the company is beating consensus by a considerable margin. They're then raising guidance, having beaten consensus. They're then smashing that guidance and then raising again. And the net result is that analysts just, poor little fellas, just cannot keep up. And that's why the prices continue to advance. And really, if you look out over the next couple of years, and I'll come back to this discussion in a minute, if you look out over the next couple of years, you can actually make a case for the fact that NVIDIA is still attractively priced if you're looking a couple of years in advance. If you want to just look at the old methodology, you could conclude that, well, NVIDIA's gone up a lot and it's very expensive. But what I'm going to suggest to you in the coming 15 or 20 minutes is that really the market has changed, it's shifted quite dramatically, and as a consequence, it needs to be looked at through a different lens. And one of the aspects of that is that AI and data centers and everything related to it, this is not a rerun of 1999 and 2000 with all the hype around the internet. There is massive commercial justification for this growth. It's real, it's massive, and it's going to go on for decades. And you can't say that very often. There's probably only been a couple of times in the last 100 years where you can say that, but that is very much the case now. Narrowing the focus a little bit more to the next 3 months rather than the next decade, there is definitely a bit of a mixed economic picture in America because retail sales are slowing a little bit. The PCE, the personal consumption expenditure, which is a favourite metric of the Fed in deciding what they're going to do, that came in steady for April, the same as it was in March, and that was just below expectations. So the inflation situation in America is certainly not, it's not turning around and starting to go back up again. That's the key thing. Now, there's a couple of ways that this can play out. Firstly, if there's a modest slowdown economically in America and it's steady and gradual, then that'll actually be great for the markets because it will allow the Fed to start making a few rate cuts, and that keeps the market happy. So that is the ideal, that is the preferred scenario, and we'll just have to wait and see whether that is the outcome. The other alternative is that we get a larger slowdown, happens more quickly, and that, of course, that will then flow through to corporate profits and margins, and you then are heading down the track of stagflation, and then the market will start awarding lower earnings per share multiples to stocks. And that could see 10 or 20% come out of the market at the index level. But let me make this point very clear. There will still be stocks, even if that happens, there will still be stocks that will do incredibly well because they're pretty much resilient and independent of the general economy. So you don't want to put every stock in the same basket. There will still be fantastic opportunities and fantastic outcomes. So please remember that very clearly. Now, as I said earlier, the future of investing is going to be very different. It requires a rethink. It requires a different approach. AI changes everything. It really does, and it's real. It's not hype. It's not going to run out of gas next year or even in the next 5 years. Um, as I said earlier, that is not something that you can say very often. You might only get to say it once in a lifetime. But that's where we find ourselves right now. And increasingly, we're going to see a wider and wider gap in outcomes between the winners and the losers. We're going to have a relatively small percentage of the market do extraordinarily well, along the lines of what NVIDIA has showed us this year. And the rest of the market is going to get left behind, and it's going to get left behind probably at an increasing rate. So for investors that want to behave the way they have for the last 30, 40, 50 years, there is a massive amount of danger in the market that you be left behind. It is absolutely critical that you start to think more in tune with the market and the environment that we have now, not as it has been. So if you're caught up with doing the same old, then you need to rethink the way you're approaching the market. And using diversification as the primary means to managing risk. And I've been talking about this for years and years and years, 10 years. So this is not me jumping on a new bandwagon. Diversification as the primary means to manage risk is going to become dangerous because there are going to be many stocks that investors just, traditionally accept that, I'll be invested in Australian banks, or I'll be invested in this or that particular stock, because that's the way it's always been. That sort of consensus group thinking. If you do that, you are going to get left behind compared to what you could do. And that is just so crystal clear in my mind, it's not funny. There are going to be many, many household names. And I won't go through them now, but there are many that you can find that have underperformed for the last 5 years. Not only have they not done anything, they've actually lost value. And these are the stocks that are supposedly diversification will protect you. Well, guess what? They don't. So there'll be many household names that will drastically underperform. So it's not just a matter of you not doing as well as you otherwise might. There is a very real chance that if you just do what everybody else does, that you will go backwards. So new valuation paradigms are required because it's very easy to look at stocks like NVIDIA in America, and there's plenty of other examples in Australia, stocks like Promedicus, stocks like CSL, to look at those and say, well, right now they're expensive. But if you look a couple of years down the track, they, as you could have done in any 2 to 5 year period over the last 20 years, you will look back and realize that that was an opportunity staring you in the face, that they actually weren't expensive, that they actually offered fantastic high probability growth for the long term, and that those high multiples would be sustained. So new ways of looking at the market, not just defaulting to the traditional valuation metrics are required. Otherwise, you're going to just block yourself out of the market because of perceptions. So a very different game plan is needed, and this is what we're up to our armpits in the Insiders Club and Portfolio Analyst in doing, in zeroing in on the stocks that are going to do incredibly well. Some of them are very attractive, even on the old valuation metrics, but some of them look expensive. But they always will, and they're probably going to keep performing better than the rest of the market. So the net result for me for the next decade is that if you're smart and you're on the right, in inverted commas, slivers of the market, then you can get returns well above average. But you've got to really focus on those right slivers. And whilst it's simple to say, it's not that easy to do. You've got to do a heck of a lot of homework. You've got to be immersed in the market, or you've got to be attached to someone who is immersed in the market to understand what is the smaller group of stocks that are going to do well regardless. So this is the way that I think about the market. High growth is the first criteria. If a stock doesn't have high growth, then I'm just not even thinking about it. It's got, I will not pick up on a value situation, for instance, if there's no growth there, because that's why values, so-called value stocks, have underperformed for the last 5 years or so, because growth, high growth, papers over a lot of other headwinds and short-term problems. So high growth is the first criteria, but there's a lot of high growth stocks or potential high growth stocks that are never going to make it. So the second thing is, what is the probability of that growth being achieved? Is that growth going to be, that high growth going to be sustainable no matter what? No matter what happens to interest rates, no matter what happens to economic activity, that growth is going to be there over the long term. So valuation then becomes less critical. And, I'm reminded of the famous words of Warren Buffett that you want to buy a great company at a fair price rather than trying to buy an average company at a great price. And I think that one of many statements of Buffett's has been proven over and over again to be valid. So valuation, whilst I don't dismiss valuation, and I still get excited by growth stocks that are cheap, first and foremost, they've got to be a high growth stock and they've got to be highly probable of achieving that growth. And if you don't have those two things, then to me, everything else doesn't matter. Forget what the valuation is, just doesn't matter. So if we look at what does high probability mean? Well, there are a number of aspects to this, but one of them is certainly around management. You want astute management. You want outstanding allocators of capital. Now, you can get that from their track record, obviously, but you can also get it from indicators like return on equity, return on invested capital, for instance. You don't get consistent long-term growing return on equities with average quality management. It just doesn't happen. So that is one vital aspect. And the second one is that the company has created an environment through whatever means where they can retain pricing power. They're in a niche. They've got an economic moat. They've got an indispensable product or service that will allow them to retain that pricing power no matter what happens in the economy. And they're the stocks that the market is going to continue to award high multiples for the long term. And that's where you can, these are the wonderful long-term wealth accumulators where you can expect to do incredibly well over lengthy periods of time. Now, my method, just to get a little bit more specific, first and foremost, you need a very dynamic and active watch list. And the lens that I look through is that the stock that I'm looking at must have a high probability of achieving a 20% plus return per annum over a period of 2 to 5 years. That's the lens that I look through. And if I don't think the company can do that, then I just, next, just don't even give it any more consideration. And then I want to have at least double. So if I want to own 20 or 25 stocks in my portfolio, then I want to have at least 40 or 50 targets on my list at minimum. Because the last thing you want to do is get your heart set on owning a particular stock and then buy it at an inappropriate price. Because there are still, even though these stocks are great and they're going to be fantastic over the next 5 years, there are still good times to get into them and there are poor times to get into them. There are stocks that I've waited 12 to 18 months for. Stocks like Promedicus, for instance, like ResMed. And I patiently waited until an event occurred that dragged the share price down to an area that was attractive. So you need a big and healthy and dynamic watch list. And it's just the only way to go about getting those significant long-term returns. Now, we're delivering that, if I can just wave the flag for a couple of seconds on what I do, the services that are offered. Portfolio Analyst is a once-a-week service which is suitable for investors that are either pretty self-directed but are looking for additional ideas, looking for answers to questions, looking for perspective on the market, all those sorts of things. Or they're someone that wants to understand my methods, gets to know how I do things, to get comfortable to maybe take the next step into the Insiders Club. And the Insiders Club is the full service, daily, all the bells and whistles support service with very specific recommendations. And that ultimately is where most people end up in their membership. The third alternative is, if you don't really want to be on the ball yourself, doing this, making all your own research, then there's the portfolio manager service where we do all the work, but you retain control. So that is the way that we're delivering the process that I use. All right, and just going back to that last point, the high probability of 20% plus per annum, not all stocks will or do achieve that. But equally, there are stocks that have delivered triple-digit gains, and some of them well over the multi-bagger hurdle. And they more than offset the periodic losers that do occur, where things change or where the company starts to underperform. So just to make that point really clear. But the overall intent and in practice, and the results are showing that, is that we're certainly meeting that objective of those long-term returns. And if anyone wants some more colour around that, then talk to me, because we've got all the evidence to show you that those returns are recurring. Get in touch with me and we can talk it through. All right, turning to the American market now. The S&P fell 0.5% across the week. The NASDAQ was down 1.4%. Overall, there are outstanding stocks in America. Again, this is only a sliver as a percentage of the whole market, but there are outstanding stocks that are being rewarded with very powerful trends, quite justified. Some of those trends mean that those stocks have now become crazily overvalued, but also there are some that are not. And there are some that are just downright cheap, even though the share price is trending strongly. Their earnings are growing so fast that the market just can't keep up with it. NVIDIA is an example, but there are many, many small and mid caps that are examples there as well. US dollar index was pretty much steady. It increased just a fraction. The 10-year yield edged up a little bit, and the VIX also edged up a little bit from the last time that I did one of these videos, from 12 to 12.9. Let's go and look at some charts. This is the S&P on a weekly, so you can see we did trade lower, but managed to bounce on Friday and only ended up losing a little bit. Just while I'm here, this is the equal weight S&P. So this is a market cap weighted S&P result, which is what you normally see. So heavy influence of the mega cap stocks. But this is the equal weight. So this is the S&P 500, but with market cap taken out as an influence. And you can see that it is still doing quite well also, which means that this performance in the S&P is not just because of the mega cap stocks. This is a very broad-based rally. And if you go to the Russell 2000, then you see it again. The Russell 2000 is still performing pretty well. So that, and we'll just look quickly also at the NASDAQ. So there's the NASDAQ on a weekly basis as well, similar sort of pattern to the S&P. Now within the NASDAQ, semiconductors all part of this whole overall AI theme and data centers. Semiconductor index is still rising. Yeah, we had a bit of a pullback, but look at how the buyers stepped in on Friday and actually closed that quite well, considering where it had been earlier in the session. If we look at semiconductors versus the S&P, it's still a very powerful uptrend. And there will be bumpy bits. There will be times where Semiconductors and AI stocks and technology stocks in general might go through 3 months or 6 months of relative underperformance. But your game plan should be clear enough to deal with those periods. Let's look at the individual sectors. XLK still remains the strongest by far over the last month. XLC, Communication Services, also doing well. And then we've got banks and staples. It's then really a bit of a mixed bag down towards the bottom. But you can see all of them turning up in the last little bit. In Australia, information technology still clearly the outperformer as it was last week. Finance is in there, but really finance is so heavily influenced by the outperformance of the Commonwealth Bank. If you look at the performance of the other major banks, it's been downright disappointing. And then materials are impacted certainly by what's happening in China in terms of commodity demand, and energy still remains near the bottom of the pack, and I'll have some more comments to make on that shortly. Okay, so just summarising in Australia, the US dollar ended up 65.92. Our index fell 0.3% across the week with IT leading the way, but it was materials that really dragged our market down. The US dollar was just a little stronger, and that impacted commodity prices as well. Now, the key thing I want to say about the Australian market is that anyone can devise an ideal portfolio composition that suits you based around only the top performers that have all got very powerful tailwinds. You can all do that. Now, most of you can't and won't be able to do it on your own because you've really got to be heavily immersed in the market to be able to do that. It's an enormous research effort, and it's an enormous amount of continual staying across the market. But you can get that through other means, which are pretty obvious. And once you understand what you want your ideal portfolio composition to look like, and you generate a watch list of target stocks that is significantly bigger than what you need, then it's just a matter of sitting back and waiting for the opportunities. And the names almost jump off the page and bite you on the nose. It becomes so obvious. It's just a sequential sequence of thought to work through. And once you've got that, then I promise you your results will improve dramatically. It's just patience and discipline from then on. Precious metals, gold was down $6 on the week to 2327, but of course it had a pretty poor week previously, the week before that, which I'll get to. And despite the relative buoyancy in gold over the last year or two, it's really only central bank buying and some institutional activity in the futures and options market, being long in futures and options, that is really a positive in this market. We've still got fund flows into either gold ETFs or gold miner ETFs that remain overall negative. So it's not a situation that I've seen previously where the market is being sustained so heavily by just central bank buying. But that's where we're at. Silver finished at $30.41. It was up above 32 at one stage. Gold in Australian dollars, 3498. So it's come off a bit more than $100, $150. But that's still very profitable territory. When we look at stocks, there is still no general rally. There's no real enthusiasm. We're seeing it in the fund flows into the ETFs. It's just not there. But there are a few outperformers, and they're the ones to get focused on. So let's go and take a look at that part of the market. We'll look at silver first of all. Silver on a weekly chart. You can see over the last couple of weeks, the last 3 or 4 weeks, it's been initially very, very strong, powerful breakout, and then it's become quite volatile over the last 2 weeks and closed near its lows. But really, this is looking there's so much strength here that this is looking more like a breakout, a retest of the breakout, and I think the odds favour the next move being to the upside. This is the relative comparison between silver and gold in US dollars, and you can see silver has got more volatile in the last couple of weeks, but is definitely outperforming gold at this point in time. And there's the gold price in US dollars on a weekly basis. Not a lot of change, but the previous week we hit a new all-time high of 24.50. So this is still a pretty strong uptrend. If we look at GDXJ, not a lot happening there. It's, we're just starting to limp towards higher highs and higher lows, but there's nothing terribly enthusiastic about there, and there's no real increase in volumes either. Relative comparison, this is in Australian dollars GDX versus gold in Australian dollars, and the gold price is still outperforming the actual gold stocks themselves. So that's the rundown on precious metals. Other commodities, copper dropped quite sharply back to $4.60, just as everyone was getting very excited about copper at $5.10. And nickel also came off the boil as well, down to just below $9. So for copper, it's 2 steps forward, 1 step back, but the trend is definitely up and the fundamental outlook is very, very strong. It's what we've seen in the last week is healthy. So if copper stocks are part of your desired portfolio, then you want to take advantage of this weakness. This is the time to be buying, not when everyone's getting enthusiastic about copper stocks. West Texas Intermediate crude cooled off a little bit, down about $3 on the week, and ostensibly US gasoline demand was down a couple of percent. But look, I find energy investing is tough, particularly in Australia, especially in Australia, with the sort of energy minister that we have. And government intervention just creates uncertainties. I try to focus just on the slivers of the market where there is almost no uncertainty. Now, that's nirvana, and you don't ever quite get there, but that's what I try to do. And a sector like the energy sector in Australia is just plagued with uncertainty, so I just rather leave it alone, to be honest. Lithium, the risk and reward over the next 12 months, there is certainly some signs that the lithium market may have bottomed and is stabilising, but the upward signs are not really that strong yet. And I like to work on probabilities. I don't work on hope or guessing that the lithium market might have bottomed. I want to see the fundamentals in good shape, and I want to see the charts reflecting that. And a possibility is, a decent possibility is that lithium supply is rising, and it could rise quite sharply. And this is according to Morgan Stanley. So this is not me saying this. This is Morgan Stanley. Supply is rising. And there are some particularly solid reasons why we're going to see that supply, whether it be from Australia, Africa, Chile, all raising exports. And that, of course, will put downward pressure on the price of the commodities, whether it be spodumene or whether it be lithium carbonate or whatever it may be. Now, if demand growth continued to accelerate, then that's all good. We can have a rising supply and prices can still be healthy. But there is also a bit of a question, and this is the second part of it, of the balance, is that the demand growth could be flat to declining. And there is certainly some evidence that the balance between electric vehicles and hybrid vehicles is shifting back a bit towards hybrids. Now, I find that the data coming out on this is highly variable and it differs from source to source. So I don't present that with any great degree of confidence, but I just note that there is certainly some data that strongly suggests that there are less people proportionately buying EVs that are buying hybrids. And that puts a bit of a dampener on demand. So just something to bear in mind. Don't get too enthusiastic about lithium just yet. There's the spot copper chart. You can see it's the very impressive surge that we saw in early May has now pretty much reversed, and we've given most of it back. And spot nickel looking pretty similar. A little bit of that is the US currency, but not a lot. It's really more of the 2 steps forward, 1 step back sort of process. Wrapping things up, this is the most exciting decade that I've ever seen. I've been saying that since 2018, 2019. Now, the character of that has changed. So things that I saw in 2018, 2019 that had me expecting this decade to be really, really good have shifted. Nevertheless, they're still there, and they're still very, very exciting. But it does require that you need to shift your approach. So I'm doing things a bit differently now to what I did back in 2018 and 2019. You've got to shift with the times. You can't just lock into a process and think that that'll do you for the next 20 years. You're going to be significantly disadvantaged. So you need to know how to play the most powerful thematics. And again, that's what we do every day, every week in the Insiders Club or Portfolio Analyst. It's making sure that we're right on top of those thematics and how to play them in the best possible way. The other reality is that artificial intelligence will broaden into many other areas. At the moment, it's all about the builders, but there are going to be many other beneficiaries in other areas outside of technology that are going to benefit. But you need to be on your toes, because it won't be a tide that will raise all boats. And it's going to be very easy, I think, to lose money in AI, even though it looks absolutely bulletproof, unbreakable, fantastic for the next decade. You can still lose money. You can lose money by buying overvalued, poorly managed businesses, and there are always going to be plenty of them. Always have been, always will be. So stock selection is absolutely critical. Portfolio Analyst last week, we looked at, and it reflected a lot of what I've talked about this morning. We looked at long-term wealth compounders, but with a difference. Because you can pay way too much, and therefore your returns over the next 2-3 years can be quite muted, even though the business is doing very well. You just paid too much at the start. So there's a process, and sometimes it requires a lot of discipline. There are also outstanding small cap growth stocks in Australia that are producing terrific long-term returns. We looked at data center plays as well, and we also looked at my preferred stocks in uranium, gold, silver, and copper. So it was a pretty productive session in Portfolio Analyst. Anyone that's not been there, there's a $1 2-week trial that you can take advantage of, and that's the opportunity to get more substance to what I've been talking about this morning, to get to understand, if you like, the approach that I take and the methods that I use. So that's it for this week. There's more information on the website. There's my email address. I'll be back with you next Sunday. Cheers.